If you own a short-term rental like an Airbnb, there is a strong chance you are paying more in taxes than you need to, and most owners do not realize it. In this video, we are going to explain how cost segregation works for short-term rentals, why it can be even more powerful than for traditional rentals, and when it actually makes sense to use it. Let's start with the basics. When you own a rental property, the IRS allows you to deduct the cost of that property over time using depreciation. For residential rentals, that timeline is 27.5 years. That works fine for long-term rentals, but short-term rentals operate very differently. Short-term rentals typically have more furniture, more appliances, more lighting, more finishes, and more wear and tear. And many of those components do not last anywhere near 27.5 years. That is where cost segregation comes in. Cost segregation is a tax strategy that breaks a property into individual components and assigns each component a depreciation life based on IRS rules. Instead of depreciating everything slowly over decades, certain parts of your short-term rental can be depreciated over 5, 7, or 15 years. Examples include flooring, cabinetry, appliances, lighting, electrical systems, plumbing components, and exterior improvements like walkways or landscaping. Now here is where short-term rentals get especially interesting. If your short-term rental qualifies as a business instead of a passive rental, accelerated depreciation from cost segregation may be used to offset active income. This depends on how the property is operated, how many days it is rented, and how much material participation the owner has. That is why short-term rentals are often one of the most powerful use cases for cost segregation when structured correctly. Let's walk through a simple example. Imagine you purchase a short-term rental property for $1 million excluding land. A cost segregation study might identify $250,000 to $350,000 of that value as short-life assets. Instead of depreciating those assets slowly, a large portion of that depreciation can be taken much earlier. This reduces taxable income significantly in the early years, which means lower taxes and stronger cash flow when you need it most. Now, an important clarification. Cost segregation does not increase total depreciation. It simply changes when depreciation is taken. You are pulling deductions forward into earlier years instead of waiting decades to receive them. That timing difference can make a major impact, especially for short-term rental owners who reinvest aggressively or rely on cash flow. Cost segregation can be performed on newly purchased short-term rentals, after major renovations, or even on properties you already own. In many cases, prior missed depreciation can be caught up in a single year using a change in accounting method. Of course, this strategy must be done correctly. A proper cost segregation study should be engineering-based, well-documented, and coordinated with your CPA to ensure compliance and audit defensibility. This is not a DIY spreadsheet strategy. The right study protects the deductions you claim. If you own or are considering a short-term rental and want to know whether cost segregation makes sense for you, the first step is simple: run the numbers. Visit costsegregationguys.com to request a free analysis and see how cost segregation could impact your taxes and cash flow.